a lot of people know intuitively that when it comes to investing, when it comes to day-to-day activities, it's always about probabilities. The thing is, probabilities in our business often just come with a single roll of the die, which means even if the probabilities of something happening are high, it may not end up happening, right? Because there's still a low probability something doesn't happen. You only have one shot, right? As far as how that analysis ends up playing out.
You tell a lot about the markets by what's leading and what's lagging, by which stocks and asset classes are rising and which stocks and asset classes are falling. So what messages are markets sending out now, and how should investors position themselves as we head into the final quarter of 2024? I'm Mike Larson, host of the MoneyShow MoneyMasters Podcast. Today, I'm sitting down with Michael Gayed, editor of the Lead Lag Report and host of the Lead Lag Live Podcast. I'm going to get those answers for you. Mike, welcome to the show.
I hope I can find somebody else who has the answers. And it's like I want to do the phone a friend thing from what was it, the weakest link? I think it was, right?
Oh, there you go. That's a great Wayback Machine memory there.
Totally.
Well, anyways, let's start just by big picture. I mean, a lot of people I know follow your work on Twitter and X and what you do with the podcast. But if somebody doesn't know a little bit about your background, why don't you just tell me, why you have this lead lag approach to markets and why you think it's so critical?
Look, there's nothing that's ever guaranteed in markets, but the closest thing to guaranteed, which again is a loaded word from a compliance perspective, is mean reversion. Right? It's like I always go back to mean reversion as a concept that's as old as the Bible. Right? He who is first shall be last, and last first. He who leads will lag, and he who lags will lead. Right? That kind of thing. Yep. So there's always going to be these ever evolving dynamics where there's new leadership. Leaders become laggards, so on and so forth. And a lot of the work I try to do is try to identify from a sector perspective, asset class perspective, the conditions where you're going to have a shift in what's leading, what's lagging. Sometimes I'm right, sometimes I'm wrong. One thing I certainly am is loud about my views.
Why not, right?
Yeah, I mean, you kind of need to be. I mean, look, I always go back to this point that no amount of intelligence can increase the clarity of one's crystal ball. Right? I don't care how smart you are. I don't care what your net worth is. Nobody knows what tomorrow brings. Right? It's why I try to frame things in terms of conditions that favor something happening. And it's the thing, right? It's like I find, and I'm sure you see this too, a lot of people know intuitively that when it comes to investing, when it comes to day-to-day activities, it's always about probabilities. The thing is, probabilities in our business often just come with a single roll of the die, which means even if the probabilities of something happening are high, it may not end up happening, right? Because there's still a low probability something doesn't happen. You only have one shot, right? As far as how that analysis ends up playing out. But certainly I think I hope at least I bring a certain degree of consistency in the way that I think about things, whether it's right or wrong. And to the extent that I've been wrong about the AI trade, but also right about gold, the reality is that's how this business works. You're right on things, you're wrong on things. The key thing is, are you able to identify the probabilities and the conditions first?
Got it. Well, let's talk about this market environment. I mean, as we're talking, we've had something like 40 record for the S&P 500. You got Wall Street strategists are throwing out 6,000 plus targets kind of left and right. Optimism abounds. What's wrong with that picture? Or is there something wrong with that picture in your opinion?
Well, and credit to you, Mike, because you've been on Lead Lag Live and you've gotten that right also. You've been bullish throughout this, right? I mean, I've been much more skeptical, although skepticism doesn't mean shorting, right? I mean, skeptical just means I see disconnects and divergences. Yeah, it's like if at the start of the year I were to say to somebody listening that at this point in 2024, two of the best performing areas would be gold and the utility sector, you probably would not think the S&P 500 is up as much as it is at this point in the year because those are traditionally more defensive assets, right? Yeah. And sectors, right? But that's exactly what's happened this year. So I don't know if it's a question of is something in quotes wrong. I was just talking to an advisor the other day about this. I feel like I've been a bit of a broken record, right? Because nothing really has changed from my vantage point. From my standpoint, I still view the very real disconnects around large caps and small caps as being troublesome, meaning, sure, 40, I think was the number you said on the S&P 500 new highs this year, but small caps have not made new highs, right? I mean, relative to 2021, they're still below that level. Yeah. I would argue that small caps are more a reflection of the U.S. economy than multinational large caps. which makes me also suspect in terms of the true strength of the economy, the true strength of employment in general, because most hiring happens from the small cap side of things. They've been held back by higher for longer rates. Even with this Fed cut of 50 basis points, it doesn't seem to be causing that much excitement, at least so far, around the small cap end when that's the most sensitive part of the marketplace. All while, again, defensiveness seems to keep on leading. Gold has been on fire, right? So it goes back to what I said before. I've been wrong about large cap momentum persisting, driven by the AI trade for as long as it has.
Yeah.
But clearly, there's still plenty of opportunities, even if you're, in quotes, bearish equities, by just not being in equities.
Well, let's talk about that message. You noted, again, you do great work on Substack. I love following what you have to say there. You talk about treasury yields falling in a recent piece, gold rising, utilities. Again, as you point out, that tends to be a sort of defensive type environment. So why do you think equities are holding up? What do you think is going on there? Or what's the message you suss out from all of this?
So it's not going to be a very accurate, or maybe not accurate. It's not going to be a very popular way of saying it. But I think the reality is we're still in a very unusual environment, and that nothing is sinking the way you would normally think it should, which I know sounds like it's a cop-out answer, but I keep going back to think about what we've gone through the last 3.5, 4 years. Shut down with COVID, reopening with COVID, fastest rate hike cycle in history, all the stimmy checks. Each of these are monumental, and each of them have their own lagged effects on the economy. So to some extent, it kind of makes sense that nothing looks like it's making sense when you look at what usually is co-movement across certain parts of the marketplace, giving the same kind of message.
Yeah.
Normally, you would see, for example, that when credit spreads are tight, differential between junk debt and high quality paper, small caps would do well. Small caps are the junk debt equivalent of the equity space. Junk debt is the small cap equivalent of the bond space, right? Just from a leverage perspective. And yet they've given two very different messages as far as default risk. Again, maybe you can say that that's to be expected given the lagged effects and everything still being so unusual post-COVID. The good news is that every day that goes by, you're closer to hopefully a resync. Resync meaning you have consistency of different asset classes and sectors telling you the same thing, as opposed to what is very clear, different messaging. How that messaging resolves is anybody's guess. I mean, I tend to be more on the negative side because I believe that you can't have an environment that's just dominated by one story that doesn't permeate through all parts of the marketplace. Again, if AI is real, then small caps should be beneficiaries, but they haven't been, right? It's about if AI is about productivity, then you would think that there's going to be a big boom that's coming for small caps as they use these tools. Hasn't happened.
Fair enough. Fair enough. Question for you on the Fed here. I mean, obviously everybody, I wouldn't say everybody's surprised. I mean, I was kind of looking for a 50, so it didn't really shock me. And, maybe 1/3 or so, 2/3 of the people were looking for that. Why do you think the Fed went 50? And, what do you think the message is there going forward when it comes to rates and the Fed?
It's an interesting question, right? Because it's not like the market was betting on 50 basis points becoming a higher probability as we were getting closer. Yeah, it wasn't like it was always baked in, right? From that standpoint, it's a good question. So personally, I believe that it's more a sign of some degree of, in quotes, panic, right? It's like I put that post out and it went viral. It's not a bullish thing; it's a panic thing. The issue, I think, from the way I see it, is why do they feel compelled to start off that aggressively when history shows that when they start off that aggressively, it's actually not a good thing going forward. Yeah. Now, again, the market has taken it in a positive way, at least for now. And I will remind people that more often than not, 3 months after the start of a Fed cutting cycle, 3 months afterwards, markets on average tend to be lower, not always, going back to the 70s. So we could still see stocks go down, meaningfully. As far as the Fed and its reasoning, my only guess would be that they are probably legitimately worried about the unemployment rate. That becomes more the focal point of their attention, especially in an election year, as opposed to inflation. Remember, there's a dual mandate, but they can choose to favor one over the other. I think the unemployment rate is probably the bigger thing now.
Okay. Another big topic that's out there is kind of China stimulus. Obviously that market's just been sort of this long, slow slide. Equities, real estate there has been a huge mess for years. What do you think turns that around, if anything? Do you think some of the moves they're making here are going to make investors look at global stocks, look at Asian markets, China in particular, moving forward?
I think to some extent you answered your own question when you said for years. It goes back to mean reversion, right? Who's first shall be last and last first. Leaders become laggards, laggards become leaders. Time is often the catalyst for that, right? It doesn't necessarily have to be stimulus. It can just be time happens. Look, I mean, obviously the markets, as we're chatting, are excited about that when it comes to China. The bearishness in China has been stunning, right? Everyone's talking about a deflationary depression. Meanwhile, the China equities, even prior to these stimmy moves, held the lows. Speaking about divergences, right? It's like the equities have been saying one thing different from the narrative and what looks like a worsening economic situation. So here comes stimulus. We'll see if the excitement continues. I think the concerns around China is that, you're starting from such an extraordinary debt leverage perspective that it's hard to see how any real stimulus is going to be longer term impactful. Aside from the fact that it's clear that they don't have the same degree of culturally consumerism that the West does.
Yeah.
So it's unclear also from that standpoint, can you get the demand pull side of the consumer equation really to drive the economy there? But it's enough, I think, to at least get some investors to take a position. And that alone could cause some upward momentum. The reality is this has been such an underinvested part of the marketplace because of geopolitical risks, the optics of it for the average American investor in the middle of the country who says, why would I want to buy China when I can buy US?
Yeah.
And so from that perspective alone, I think it's a contrarian trade, but I think the key word there is trade.
Got it. Fair enough. Question while we're talking about developments in Asia, you've talked a lot about the Japanese yen and kind of keeping an eye on what that's doing and what, maybe message there is. For people who haven't been following your work, what is it you're watching there and why is it something that you are paying attention to?
We had that freak out, right? August 3rd and August 5th, and everyone was high-fiving me on this reverse carry trade idea, the idea that, so much money has been levered from Japan at its low rates deployed around the world. And the moment you have any kind of sense of the yen appreciating, that would then cause a repatriation of some of those yen and then cause a sell-off in global assets. So you had that fear moment. It only lasted 2 days and everyone became an expert on it. I don't think the dynamic is over by a long shot. And I know that a lot of people seem to think that it is, especially when you look at yen CFTC futures positioning, which is now long from flipping from being short. My hesitation in thinking that it's over is that this is a 2-decade type of dynamic that's been ongoing, where a lot of money has legitimately come out of Japan from many small businesses, many large businesses where they're not reporting their positions, right? So which means I suspect they're still actually on the private side of things, a lot more short, in quotes, yen than people realize, which still means you could still have another squeeze higher in the yen. If that happens, that still becomes problematic from a global deleveraging perspective. I think it was more of a preview, what we saw August 3rd and August 5th. Now, people hearing that will say, you've been on that drum for the last 2 years. It's not true. I've been saying this since August of last year. It's just something to be mindful of, right? And for all we know, that could be why gold is doing what it's doing. That could be why utilities are doing what they're doing, because there's still kind of a lingering concern that there is that tail event that Japan could still spark.
Yep. So let's talk about what you're generally bullish on and versus what you'd still generally call yourself bearish on, whether it's asset class, a couple of names you want to throw out. I kind of leave it up to you on that. But obviously, we've talked about gold, so I assume you'd consider yourself still a bull there, correct?
Yeah, I think the skepticism is still very real when it comes to gold. So that, I always go back to trends live on skepticism, they die on conviction. So there's still a lot of skepticism around gold. So I think gold probably does continue. I've been on that train since October of last year as well. I actually do think small caps are probably due to outperform. I mean, interestingly enough, small caps versus large caps have actually held their ratio low from July. And yeah, it's meandering. It's not having the excitement, but it's basically kind of keeping in line with the S&P, which may be the first step to a bottoming process. Now, the only caveat there is small caps can outperform by being down less. Right. So if you're going to do a spread trade, you go long, small, short, large. I think that makes sense. Right. But again, I mean, every time it looks like that's going to happen, small caps keep on weakening and weakening. I would personally avoid tech. Now, I've been wrong on that. Right. I just happen to think that it's extremely one-sided of a trade. Right. It's been a phenomenal winner. I just tend to prefer the idea that laggards become leaders and leaders become laggards. Goes back to that point. Broadly speaking, I think if you're going to take a speculative bet, I think biotech gets to be more and more interesting with every day that goes by. The reason I say that is I think in terms of factors, right? So what's driving the biotech industry subgroup? The fact that a lot of them are smaller, so the small cap factor, and the fact that there's a sector component to it, healthcare. Now, a lot of the healthcare momentum has been driven by these GLP-1 plays, which has totally made everybody not look at anything except the Eli Lillys and Novartis of the world, things like that. So people have ignored small caps. They've ignored everything except, GLP-1. That seems like a good contrarian trade also. And again, if AI is real, you would think biotechs would benefit the most. Nothing should be more apt to the benefits of artificial intelligence than the complexity of the human body. Right. So I think now the caveat there, of course, is that you got to be careful with it. It's obviously very idiosyncratic in terms of the individual companies. But I think that part makes a lot of sense from a longer term perspective. Okay.
I guess as we get towards the tail end of this conversation, I mean, what is the one trigger thing or indicator you're watching that maybe signals, some of these concerns I've been having and speaking about are really coming to the fore? Is it something in the credit markets? Is it something in equity markets? What specifically would you be looking for as a sign to people who follow your work? Hey, this is the time to get more cautious.
So if I've been right about anything about the reverse carry trade, is that it would bring back the behavior of the flight to safety dynamics back into treasuries. So ever since that happened from August 5th on, whenever the equity market is down heavy, you end up seeing long duration treasury yields dropping, which is very sensitive to me because my funds are built on that very concept, right? My mutual fund, my ETFs. So that is, I think, an important change to the way things once were, right? Now, in order for that dynamic to hold, you need to have credit spreads widening. So differential between junk and AAA, which is what forces the flight to safety, which has been what's been missing throughout this. Now, if the unemployment rate were to keep on rising and you do have some kind of a recession, you would expect the credit spread should widen because it's about default risk. Right. So I think, and it's interesting because actually leading up to the 50 basis point cut, spreads were widening and then they just cratered yet again.
Yeah.
Right. So it's almost like the Fed was trying to whack-a-mole that very quickly. Like they were, you can argue, in October of last year when spreads were starting to widen and then they came in and got the market to think 6 cuts were coming. Obviously, they're looking at credit spreads probably day to day, right? No different than I am. The question is, can they get ahead of it enough times? So I think credit spreads are important. I think the behavior of treasuries is important. The housing side of it is going to be intriguing to see how this plays out. Lumber has been obviously weak pretty much all year. Home builder stocks have been strong all year.
Yeah.
There's differing messages there. It goes back to divergences. Lumber is a tell on housing because of construction, but the home builder stocks are clearly saying there's a lot of activity still coming. So we'll see on that end. But I think if you're going to rank them, I'd say credit spreads become the number one thing to focus on.
Mike, you're going to be joining us for the 2024 Money Show in Orlando, mid-October. I'm curious, can you give a sneak peek at maybe what you think you're going to be talking about there and, what somebody who comes to your session is going to learn and pick up?
So, I've been doing these, I think I've been doing like 700 different guests over the last 2 years, right? Top 5% podcast downloads. And I tend to not prepare at all when I talk to people. It's more just listening and, maybe interjecting some of my own thoughts on markets, but really just listening and trying to do vectors off of conversation. So I think what anybody that joins will hear is authenticity and a legitimate conversation among two professionals. Hopefully I'm considered a professional in the industry with other people that are coming from the same place as I am, in that neither of us will know, whether it's me or the guest, what tomorrow brings, but we'll try to provide some color context around how we think about things. And from that perspective, I'm excited because oftentimes, as you know, interviewing somebody in person is very different than doing it via screen like this. I think it's actually going to be much more natural and intriguing to have it one-on-one like that.
Yeah, great. I mean, absolutely. I 100% agree with you there. Mike, thank you so much for your insights. Viewers, if you're watching, you'd like to learn more about what Mike's going to be talking about. Again, he's going to be at the Money Show Orlando. It runs October 17th to 19th at the Omni Orlando Resort at Champions Gate. You can find more details by clicking the link in the video description below. And don't forget to like this video, follow us, subscribe on our channel, and you'll get more content like this. Mike, good talking to you. Can't wait to see you in person again in a few weeks.
Yeah, likewise, Mike. Looking forward to it.